The Federal Reserve, after hiking 75 basis points in the July meeting, decided that they anticipated further rate hikes ahead. They said they needed to move to a restrictive policy. They said it was required for them to meet their policy goals of low unemployment and stable inflation. The pace of future rate hikes, however, was data dependent, and it was a little tricky to read these minutes and get a read on a 50 or 75 from the September minutes, and I'll explain why here in a second. They said it would likely be appropriate to slow the pace of tightening at some point. No indication when that would actually happen. But after the 75 basis point hike, the funds rate was seen by several participants in the range of the long run range of its neutral rate. But some participants thought because inflation remains high, it was still below the shorter run neutral rate, meaning the Fed had more work to do in that regard. Some expected the Fed to hike and maintain the level for some time. We haven't seen that language before, although several Fed officials did sort of talk about that idea that it was likely the Fed would reach a certain level and stay at that level rather than cutting, which is what the market has priced in now. There was also quite a bit of concern about tightening too much. In fact, many were concerned about that, so that's important. But overall, there were a lot of hawkish talk about inflation. Inflation was seen as unacceptably high and broad-based. And this is interesting. The decline in commodity prices was not seen as enough for the Fed to be comfortable that inflation was coming down. They said it was broad-based, and they said commodity prices can go up, they can go down. They want to see broader-based declines in inflation to be comfortable about that. There was little evidence, they said, of inflation pressures that were subsiding, and they said inflation could stay comfortably high for some time. And just a real quick thing on the economic outlook, they did say the second quarter saw a noticeable slowing, but they did see growth in the second half of this year. Tyler?
All right, Steve, hang around for just a little bit, and we'll talk the conversation a little bit farther with Aditya Bave, senior U.S. economist at Bank of America. Aditya, welcome. Good to have you with us. You heard Steve's recap of what the Fed said they discussed at their most recent meeting, and in light of what they did. How do you interpret the language there?
Thanks for having me. Yeah, I think the language is consistent with our base case for a 50 basis point rate hike. One thing to note is that the minutes are a touch stale because after the minutes, we've gotten, the very strong jobs report, the very strong retail sales report this morning, and the softer than expected July CPI inflation print. So if the Fed looks at that, it can say, okay, well, inflation slowed down just a touch, not just on the headline, but also in terms of the core. And we are seeing the housing and capex data suggest that the interest rate sensitive parts of the economy are being affected by Fed hikes. So if they really do want to be data dependent going forward, then I think there is a pretty good case to slow down just a little bit.
So if they're true to their word and going to be data dependent, the data, Steve, says Aditya, tells him at least that they may not do another 3/4 point, that they might come back to a 1/2 point. We just heard from Diana Olick, who used the word housing is in recession.
The Fed acknowledged that quite a bit, the housing being in recession. The Fed did not say that, sorry. The Fed talked about the housing slowdown.
Right.
And also, Tyler, they brought up this idea, which I thought was interesting, that because of the Fed's communications, which, as you know, is quite extensive, that the market, the economy may be responding more rapidly to these rate increases than it has in the past. Just take a step back from this, Tyler. Next week we're going to be in Jackson Hole. We'll be talking to a lot of Fed officials. I'm kind of realizing, reading these minutes, I have my work cut out for me. There are some differences of opinion on this committee that maybe I wasn't quite as aware of till I read these notes. There is definitely a hawkish wing and a dovish wing that has emerged, and I think that may have come out after the 75 basis point hike. That now there's a real, maybe a more intense debate on the Federal Reserve about where they go from here, with many saying that there's a concern about tightening too much. I'm not sure how well that may have been appreciated. And some are at this maintain, reach a higher level and stay there for a while. There are some differences out there, and we have to do some more reporting on this. And thankfully, we're going to get a big chunk of that next week at Jackson Hole.
Who would you say has the balance of power, and what does the Fed chair represent in terms of those wings, Steve?
I think the Fed chair is more likely to be a little bit more hawkish here. He wants to stamp out inflation and not have it be part of his record as being Fed chair of a long and lasting inflation, and one that he's, for example, moved to combat and then took his eye off the ball and have it come back. My best guess is that's the way Powell feels about it. I will say this: following Jim Bullard has been an interesting exercise where he says things that feel like they're extreme, then they end up being the center of the committee. In other words, people scoffed at the idea of 75 basis points when he first said it. Well, guess what? They've done it twice now. Absolutely.
Aditya, what would you add to that? Where do you think the kind of center of gravity is, and where do you think it's going?
Yeah, I think the Hawks, still carry the day. I did say we expect 50 in September, but that doesn't mean that we necessarily expect a lower terminal rate. If anything, the risks from a potential soft landing with better consumer spending data are that the terminal rate goes higher, because the chain of reasoning for me here is lower inflation on the one hand means less urgency to hike in the near term. But on the other hand, it means that consumer spending and the broader economy holds up a little bit better, which means there's less conflict between the Fed's two mandates, and so they can keep hiking. So the risks are that we could potentially see a terminal rate of 4%, maybe even higher.
I want to follow up on one thought. I'll get back to you in just a sec, Steve, if I might. But Aditya, I'd like you to explain the thesis that I'm reading here. Our base case is still for a recession to start in the coming months, but the risks now are skewed toward a delay or a soft landing in the near term. So if we get a softer landing where the inflation comes down, the economy slows a bit, and we're just kind of there hovering, what is it, what changes at what point that takes the economy then into a downturn?
So basically the reasoning there would be that at some point, unless demand slows down meaningfully, the job market keeps chugging along and you get another bout of inflation, but this time it's demand driven. So the supply shocks that we saw during the pandemic, those potentially fade over the next several months, but the baton of inflation gets passed over to demand. And that could, in a soft landing scenario, which is not quite our base case yet, but that could push the Fed to do more next year.
By the way, if you're wondering why we haven't said much about the market reaction here, it's because there hasn't been much of one. Stocks are kind of where they were beforehand, Steve, as Rick makes the point. Maybe yields have now put in their highs with these tilting a little bit more dovish, you could say, than expected. And, some action in gold, slightly pairing losses. Fed funds futures, I know yours are a little bit different. Maybe the odds of 50 looks a little bit higher now versus something stronger.
That's right. Yeah, so here's the deal, Kelly. I went into these minutes thinking, okay, was the market justified in hearing a pivot, hearing a softer Fed out of the last meeting? And I actually thought these minutes would be a little bit more hawkish. What I see in these minutes is there is a path both to a lower funds rate than the one that was mentioned before, a 4% one, and there is a path towards a softer landing that is envisioned by some Fed officials. And Kelly, when you ask the question, where's the center of the Fed? I say yes. I'm not really sure where that is right now, and I need to understand that. But you can read these minutes and come off with that more dovish outlook, and you can read these minutes and you can walk away really scared about what the Fed's going to do.
Yeah, and yet the market kind of taking it in stride, Aditya, would you say?
Yes, I think so. I think the bigger news of the day was the very strong retail sales report. And really there, the surprise was the upward revision to May. It was very, very large, which moves the levels for June and July of retail sales up quite considerably. And that suggests that the consumer is holding up just fine. And again, that means, maybe less urgency to hike now with lower inflation, but risks of more later. And that's the way the markets have responded.
All right, there's the 10-year 289, so close to where we were beforehand, maybe 291. So we've come down somewhat. We'll leave it there for now. Steve, thank you as always bringing that to us. Our Steve Leisman with the minutes and analysis, and Aditya Bave as well from BofA. Our next guest says she is betting on the consumer when it comes to essentials, experiences, metaverse gaming, how to pay for it all. Joining us is Ann Berry, Threadneedle Ventures founder. So Ann, this kind of takes the retail sales report and runs with it in the sense that you don't think the consumer is out of steam here, do you?
I don't think it is. Hey, good people, sorry. Just wanted to bring that news. It was a big fat nothing burger, but we have to stay informed. When these things happen, sometimes the market is kind of flat, as you could see. Market is just like, so what? Big deal. And we'll see how the market close goes, okay? So, hey, remember, tonight, myself, Stock Mo, Keenan Grace, live. This is a live date. We're going to do 3 lives today, okay? So I just want to leave it right there. I just wanted to bring you guys this information. Please join us live. Come loaded with your questions tonight. Myself, Stock Mo, and Keenan Grace. That will be 7 p.m. Eastern time, okay? 6 p.m. Chicago time. We'll see you guys later. Live, love, laugh, and learn.